Fannie Mae recently downgraded their economic growth forecast as a soft landing from the Federal Reserve appears to be increasingly unlikely. And the soft landing they're referring to is the Federal Reserve's attempt to raise interest rates without causing a major disruption in the economy or the markets. They also recently released some new housing market forecast data that we're going to be covering in this video, where they are expecting a major reduction in the number of homes selling in 2022 and 2023, while still expecting strong price appreciation in 2022 that will slow to something more normal in 2023. I'm Tim Hamilton with StellarQuest Real Estate, and if you enjoy watching this video, I would really appreciate it if you hit the like button below, and please subscribe if you like to stay up to date on the housing market. We're going to start off by talking about why Fannie Mae is expecting economic growth to slow, and then we'll move on and look at some of their housing data and their forecast for 2022 and 2023. So we're going to start off by reading a few quotes from Doug Duncan, who is the Fannie Mae Senior Vice President and Chief Economist. So he starts out by saying, "We continue to see multiple drivers of economic growth through 2022, but the need to rein in inflation, combined with other economic factors, such as the recent inversion of the treasury yield curve, led us to meaningfully downgrade our expectations for economic growth in 2023. And so if you weren't aware, when the treasury yield curve inverts, that has historically been a very strong predictor of a coming recession. And so if you don't know what that means, I would suggest doing a quick YouTube or Google search, because I'm sure there are some videos that can explain it a lot better than I can. And then he goes on to say, data from US economic history suggests that successfully negotiating a soft landing requires monetary tightening to be preemptive rather than responsive. As such, we've updated our 2023 forecast to include a modest recession, but one that we do not expect to be similar in magnitude or duration to the recession of 2008. And then they also talk about some of the reasons they're expecting this recession to be not quite as severe as the last one we had in 2008. And so from a housing perspective, they're talking about stronger mortgage credit quality, a far less leveraged residential real estate and mortgage finance system, and a better equipped mortgage servicer and public policy apparatus, as well as ongoing housing supply constraints relative to demographic demand for housing. So basically what they're saying there is the housing market is still on a strong foundation. There's a lot of positive factors in the housing market, so they're not expecting something similar to 2008 this time around. Now we're going to take a look at Fannie Mae's most recent housing market forecast data that was recently published in April. And based on what I'm seeing, when they're referring to a housing market slowdown, it looks like they're primarily referring to the total number of homes sold as opposed to the actual price growth. And so starting with total number of homes sold here, in 2021, we had about 6,120,000 homes sell, which they're expecting to drop by about 8.6% in 2022 to 5,592,000 sales. And then looking on to 2023, they're expecting just a little bit over 5 million sales total, which would be a 9.9% drop compared to 2022. So it looks like the rising mortgage rates combined with their forecast of a potential recession has caused them to substantially reduce their forecast on the number of homes sold across the country. Now, interestingly enough, at the same time, they've actually revised their 2022 price appreciation forecast up quite a bit, while their 2023 number has stayed roughly the same. So in 2022, they're expecting 10.8% appreciation according to the Fannie Mae Home Price Index, and in 2023 they're expecting about a 3.2% increase. Now, interestingly enough, looking at their interest rate forecast, they're actually forecasting an annual average of 4.3% on the 30-year fixed rate mortgage for 2022. So that's actually about a full percentage point lower than rates are currently sitting at today. And then they're expecting a 4.5% average interest rate for 2023. So based on this forecast, it actually looks like Fannie Mae is expecting interest rates to come down a little bit in the future, not necessarily forecasting exactly when that will happen, but an annual average of 4.5% in 2023 would be about 0.75% lower than where the rates currently are today. To wrap up, I wanted to read one more quote from Doug Duncan that specifically addresses the housing market. He states, "We expect housing to slow over our forecast horizon as well. Mortgage rates have ratcheted up dramatically over the past few months, and historically such large movements had ended with a housing slowdown. Consequently, we expect home sales, house prices, and mortgage volumes to cool over the next few years. In particular, we expect house price growth to decelerate to a pace more consistent with income growth and interest rates. Households with a 3% 30-year fixed-rate mortgage are unlikely to give that up in favor of a mortgage closer to 5%. And we expect this so-called lock-in effect to weigh on home sales. Moreover, if mortgage rates remain relatively elevated, we expect the added affordability constraint to price out some would-be first-time homebuyers and contribute to the slowing in demand." And so that really does a great job of explaining why they're now expecting much fewer home sales in 2022 and 2023. Of course, many homeowners now have an extremely low interest rate locked in, and so they're going to be much less likely to want to make a move if they have to give up that much lower interest rate. So if you want to read this, just let me know. I'm happy to send you a copy of the article. If you're thinking about buying or selling a home in Southern California, I can personally help you out. And if you're located elsewhere, I would be happy to refer you to an experienced agent in your area. So once again, if you like to stay up to date on the housing market, make sure you subscribe and please like this video if you enjoyed watching it.